Hi, this is Alan Gassman. I am here with Andy Barg, and we are going to talk about advanced tax planning and strategies for insolvent taxpayers. In particular, Andy is going to cover state law impact and state tax law impact for bankruptcy situations. Ken DeGraw is also going to join us in a few minutes, and we're going to be talking about things that you really normally don't hear about in this area, but wish that you had. We welcome questions, comments, and suggestions. We'll be checking the question box during the presentation. We're scheduled to go 45 minutes. We may go a little bit longer than that. If so, it will be more than worth your while. You also have our email addresses here, and as always, send Andy and Ken the difficult questions, send me the easy ones. Now, we're going to also be back Friday, December 4th to talk about subchapter 5, the new chapter 11 device under bankruptcy law for debtors who owe less than $7,500,000. You do not need a creditor's vote to get your plan passed in a chapter 5 bankruptcy, in a subchapter 5 bankruptcy. So that's a real nice thing for debtors, and quite candidly, it's going to change a lot of negotiated settlements for debtors who just don't have the creditors on their side, but the judge will be on their side because the judge wants to keep the business open and the people employed. And that's what it's all about for a lot of us. So also on November 4th, we spoke about taxation of individuals and businesses during and after bankruptcy. This complements and does not repeat what we're talking about today. So if you have not seen that, you can go to YouTube and you can watch that video. I'm sure there's better things on YouTube, but there's probably worse things on YouTube as well. Andy Barg, very impressive in Fort Worth, Texas, specializing and really passionate about accounting and taxation relating to bankruptcy. So when we get out of our areas, we always go for help. And in this area, I always go for help. And Andy is certainly one of the people to go for help also. And now you can see Ken DeGraw's ceiling has joined us. Ken isn't on yet. Hopefully he's doing some important work for another client. I promised Andy that I would keep my portion of this talk very short, and that's exactly what I'm doing. I have about 25 pages of slides that I am not going to cover, other than to take you through 3 math examples, because this is very confusing and quite maddening, actually. So here you have a debtor with $3 million of debt owed on a building worth $2 million, which has an adjusted basis of $1.8 million. So the creditor is willing to forgive $1 million of the debt and accept the building in lieu of foreclosure, or is willing to allow the building to sell on the courthouse steps for $2 million. The creditor is going to take the $2 million, and $1 million worth of debt simply disappears. And when this occurs, it should be no surprise that the income from discharge of indebtedness, which is ordinary income under Section 61 of the Internal Revenue Code, is $1 million. It has nothing to do with the basis of the property. It has nothing to do with the original cost of the property. It has nothing to do with liberty or justice. It is simply the excess of the debt over the amount owed. Ordinary income, not capital gain, but excludable from income under Section 108 of the Internal Revenue Code if the taxpayer is insolvent, if the taxpayer is in bankruptcy, or if one of the other exceptions applies. But something else has happened here, and that is the taxpayer has in effect sold his building for $2 million and had a basis of only $1.8 million. So he or she has $200,000 of capital gains. long-term or short-term, depending upon the holding period. Where is he or she going to get the money to pay the tax? Well, not from the bank. So in order to do this transaction, the taxpayer is going to have an income tax hit. You cannot use Section 108 to exclude the $200,000. So now I go to my next example. And by the way, these are all recourse loans, and most loans in the United States are recourse. The only real exception to that, we see a lot of non-recourse in a few hotel deals and in a lot of apartment house deals. In apartment house deals, you can get Fannie Mae and Freddie Mac financing non-recourse with 20% down, and your client signs a guarantee that's only what's called a bad boy guarantee. It should be a bad person guarantee, I guess. And that is if your client steals the security deposit or steals a condemnation money or something like that, then they owe on the loan. Otherwise, it's non-recourse. All right, so in this situation, it's a recourse loan. The debt owed is $2 million. The fair market value is only $1.8 million. The basis is $200,000. So the typical accountant says, okay, you give this back to the bank, or it sells on the courthouse steps, and the bank forgives the debt by that process. It seems to me that you have $1 million of income because you have $300,000 of debt that's going away, but you have a $2 million basis. And that, unfortunately, is not the answer. The answer here is that you have $2 million of income from discharge of indebtedness, which is ordinary income, hopefully excludable under Section 108. But then you have a capital loss because the property was worth less than its basis. You can carry that capital loss forward if it's not eliminated. So this is a very interesting world that we live in. There's another example on page 11. And then on page 12, we get into the recourse world where you're basically just considered to have received cash, but all qualifying for income from the discharge of indebtedness. So you would have the Section 108 apply. Andy, did I explain non-recourse properly just there, or do you want to correct me?
Well, I think it's the non-recourse loan that not the recourse, but in a non-recourse loan situation, the debt becomes your sales price. I think
Right.
Understand that, then I think initially I think you had the recourse non-recourse mixed up.
Got it. So cancellation of indebtedness, when it happens, it's called DOI or it's called COD, but whatever it is, you want to plan ahead and hopefully fit into one of the exclusions that are available under Section 108, most notably being insolvency. If you can get rid of all the rest of your assets, so the only thing you have is what you're giving back to the bank, then you are insolvent, even if you may do that shortly before you settle with the bank or when this occurs in bankruptcy. One thing that Ken wanted me to make sure to mention is that if I owe the bank $1 million and I go to the bank and I say, hey, would you settle for 600 right now? And the bank says, yeah, we'll settle for 600 right now. Okay, well, my friend from college, Bob Smith, is going to give you $600,000 and write that note. And buy that note. And then I'm going to owe John, my friend from college, a whole $1 million. And he's going to put a lien on all my assets. So all my other creditors are going to be discouraged because he already has a lien of $1 million against all of my assets. And that is done well before any other creditor gets a judgment against me. And if my assets are only worth $600,000 or $700,000 or $800,000, my other creditors are very discouraged. So at what point will I have income from discharge of indebtedness? In that example, I will not. But let's say that my wife buys that debt for $600,000. Even though Between you and me, my wife doesn't like me very much, and she might hold me up. I still have a $400,000 income event when my wife buys the note. Now, if all my best friends from college get together and buy and set up an LLC where my wife owns 49% of that LLC and my best friends from college own 51%, then my wife and any one of my friends from college will control that LLC. That LLC, based upon contributions by my wife and my friends, could buy the note from the bank. I could own that LLC. And then even though I expect that they'll write that note down when it's time, I'm not going to have an income event. And I can wait until I want to file a bankruptcy or am insolvent or have some other situation occur where I will not have a bad income tax event when that debt finally gets written down. Ken, thanks for joining us. Did I miss anything?
I am just playing catch up. I apologize for the delay. It's just one of those mornings.
Oh, no problem. No problem. Andy, anything to add to what I've said? And I'm ready to go to your page 32.
I would add that in a partnership context, there has been some case law out there that suggests that the allocation of liabilities to a partner can affect your insolvency calculation. That generally that can be considered a debt in your insolvency calculation. That basically the debt of the partnership. So that's.
Wow, I wasn't aware of that. All right, so Andy, you want to take control of the slides here and tell us about?
Thank you very much for that piece on foreclosures and COD planning. I thought that was very, very good. I also wanted to add that there is a revenue ruling out there, 70-63. I didn't get a chance to put in my materials, but I want you to have that revenue ruling 70-63. It affects the timing of the foreclosure sale, and what that says is it looks to state law redemption rights, and generally you will not have a completed foreclosure sale until your state law redemption rights expire. So that can obviously affect the timing. It can also affect who's ultimately responsible for the tax. If you have a very short individual case that discharges within and closes within 6 months, maybe it's a no asset case, and then 6 months, maybe a year down the road, your redemption period finally expires. I think you as an individual would probably be subject to that tax versus the bankruptcy estate. But so the revenue ruling can create interesting timing considerations, and it's entirely driven by state law. So with that, we'll kind of show you this little outline. I don't have a ton of time to go over all this material, so I'm going to cut some of it short. I'm going to cut some of it out so I can get what I consider a lot of the really good material. Just a brief overview of the law and jurisdiction. There's 3 sets of legal rules that generally govern state and local taxation of individuals, corporations, and partnerships that have commenced a case under Title 11, and that is going to be your applicable state and local tax provisions. It's going to be the provisions in the Internal Revenue Code that are incorporated in your relevant state and local income tax laws, and it's going to be the bankruptcy tax code provisions, which, as a matter of law, will preempt and apply to state and local tax. Briefly, I just want to touch on the burden of proof. That generally non-bankruptcy law will generally control the burden of proof, but you know, as a general rule, there's a prima facie evidence of validity when a authority files a state tax claim. And I mention that because a lot of times I see claims filed by states or even the feds that use estimated tax claims, and you can clearly see, such as a case like a payroll tax claim, where you can clearly see in the case documents have been filed, facts have been asserted by the debtor under penalties of perjury that all employees were terminated as of this date. For whatever reason, they just didn't file a final Form 941, but the federal government comes in nevertheless. They file estimated payroll tax claims for maybe 2 or 3 quarters, and they don't actually update those claims when the returns are filed, or if you file a final return. At least that's my experience, certainly recently with the COVID problems that the IRS is having. So you want to look for that kind of low-hanging fruit and really comb through the claims of the states and look for those estimated tax claims and see if there's any circumstantial evidence that you can use to overcome a prima facie validity of the claim. And real quick on sovereign immunity, just understand that there has been case law there that's pretty much settled that states have implicitly subordinated their sovereign immunity to the bankruptcy clause when the U.S. Constitution was ratified, because you will see the word bankruptcy does exist in the U.S. Constitution. There's also another ground under Section 106A that applies when an agency files a claim in bankruptcy court. Then they automatically waive their sovereign immunity to sue when they sue a private party in federal court. That's basically what they're doing. Real quick on subject matter jurisdiction. For the most part, the CPA and financial advisor is going to look for your bankruptcy counsel to kind of see if you can throw this on their pile of work. But there are 3 concepts: arising in, arising under, and related to jurisdiction in a case under Title 11. Related to is very broad, and I've got a great definition in there that I borrowed from Collier on taxation. Arising under, I don't quite understand the legalese. Arising in, I'm more familiar with it. It more deals with interpretations of bankruptcy code that will apply, as you'll see here in a minute. Wilshire Courtyard is probably the most recent substantial authority case that establishes jurisdiction. Jurisdiction matters, and they determined there was a dispute where the partner had a dispute with the state taxing agency. The partner itself was not in bankruptcy, but the partnership was, and there was a dispute over Section 346, whether or not that applied to the transaction, and ultimately whether or not the partner was subject to a state tax on cancellation of debt. And the Ninth Circuit ruled that the court did have jurisdiction. There were also some other and very important aspects that we're going to discuss later that the Ninth Circuit did not rule on, and so it's questionable whether or not it's substantial authority, but we'll get into that here. 346 is very important, and in the state and local tax context of a bankruptcy. I'm going to skip forward just a minute, but 346 has been around for a while. It was amended in 2005 to really provide clarity in terms of what the legislator wanted to do. They wanted to harmonize the treatment of state and local income taxation of bankruptcy estates with the treatment of for federal tax purposes, particularly as it relates to Section 1398 and 1399. And I hope you paid attention to our previous section, but our previous seminars where you know more about 1398. But 346A requires a separate estate for estate tax purposes for an individual debtor estate, just like Section 1398. Section 346B provides that estates are not liable for a tax imposed on partners or members. And it's not yet clear if this new federal audit regime that allows the IRS to assess tax at the partnership level, whether or not they will be able to do that in a bankruptcy. I think if I've not seen any case law on that topic, but if it does come up in my dealings, 346B is probably going to be the first thing I'm going to point to. 346E requires the estates to use the same method of accounting. 346H requires trustees to comply with normal state and local withholding and federal withholding requirements, just as if the debtor was not in bankruptcy. 346J is very important. I'm just going to recite it here. For purposes of any state or local law imposing a tax on or measured by income, income is not realized by the estate, the debtor, or a successor to the debtor by reason of discharge of indebtedness in a case under this title, except to the extent, if any, that such income is subject to tax under the Internal Revenue Code. Basically, 346J functions as a state tax exclusion from cancellation of debt if the debt was discharged in the Title 11 case. 346J2 requires a reduction of state attributes, very similar to what you see in a federal tax code section 108. A tax on or measured by income has been interpreted to include taxes beyond just a regular income tax. In Greektown Holdings, they looked at the Michigan's modified gross receipts tax and determined that that was a tax on or measured by income. That is a margin tax. It's very similar to a Texas franchise tax, which is where I spend a lot of my time dealing with. Section 505A, I'm not going to deal a lot with here because we covered it in our previous sessions, but understand that it does apply to state and local taxes, and you do need to make these requests for prompt determinations on a state or local tax return. 1146 I don't deal with a lot. Generally, it applies to kind of a prohibition on transfer taxes and stamp tax or similar tax. 1146B I think can be powerful in terms of clarifying some of these gray areas I'm going to go into here a little later on. And it provides that the proponent of the plan can request a determination from the state or local governmental agency as to the tax effects of a plan. And if there's a dispute there, the judge can kind of determine, how the plan should fall out. And so that can be very powerful if you can see a gray area that's likely to create a lot of dispute. And certainly if you if that gray area can create so much tax that can jeopardize the success of a debtor reorganizing, you might want to consider using 1146B. I'm going to skip over some of this other areas. Section 502B functions as a cap on real and personal property tax pre-petition claims. And it generally limits the amount of those pre-petition claims to the value of the property. So allocation and apportionment. You need to be aware of your state's laws and understand that these states are really all over the map. Some of them use cost of performance, some of them use market-based sourcing, and some of them use an alternative apportionment for specific items. They may have a whole separate way of allocating cancellation of debt. And so then the question arises, well, how do you allocate or apportion cancellation of debt income? Is it, business income is subject to apportionment while non-business income is directly allocated. So is COD income really business income or is it non-business income? These are questions you need to ask and really go through your state rules and statutes. But what if the debt was incurred in a period when the taxpayer lacks substantial nexus with the state? Or conversely, what if you're winding it down and you've shut down all these locations across the street, and all that remains is a headquarters in a single state that's and a skeleton crew of accountants? Do you still have nexus in these states? I don't know. You gotta go through that. Do you include cancellation of debt in your sales factor? What if an exclusion applies? Would the answer to that question change? I'll tell you that Texas apportions cancellation of debt based on the legal domicile of the creditor, which is very generous. Likewise, they also apportion sales of intangibles to the legal domicile of the purchaser. Again, that's very generous. You can use that to do a lot of planning. It's pretty easy to set up, especially going concern sale, where you might have a lot allocated to goodwill. It's fairly easy to set up an entity in a separate state, and this the sale of that intangible can kind of fall into this black hole of state taxation where really it's not subject to Texas franchise tax. And then if you look at the law where the purchaser was set up, it's not really subject to law on that tax in that state either. So it just escapes state taxation. The federal government actually apportions cancellation of debt income based on the geographic location of the use of debt proceeds. So that's interesting. So I'm doing on my time. So when I do a state tax return, there's basically 4 layers of opportunities that I look for. One's going to be the bankruptcy code sections that we've already gone over. The others, I'm going to look at opportunities in the Internal Revenue Code. And what I mean by that is a lot of times you're going to have legal fees, financial advisory fees that are going to make up a huge portion of the expenses that the debtor pays out. And you kind of want to look at that in the lens of a state tax return, and maybe make an argument whether or not it can be a selling expense that ultimately affects your gain number and might ultimately affect your apportionment number, or maybe it might need to be capitalized and amortized. Section 263A has special capitalization rules for entities that are being organized. The IRS, when they initially came out with that regulation, of 263A regulation, they painted a very broad brush in terms of what needs to be capitalized, and they've since backed off and dialed that back quite a bit. So you're kind of left with this broad interpretation that you in turn could dial back some or take a broad approach. Either one, realize that either approach could have an impact on your state tax return. Likewise, Section 61, when you have complex issues that come up, you need to look through Section 61 and see if it requires you to include this adjustment that might be necessary to your balance sheet, whether or not that adjustment really is required to be included in gross income or not. As an example, partnerships in particularly, a lot of times you have disputes with trade creditors. So trade creditors mean accounts payable, accrued expenses, basically, not money loan, but accrued expenses. And a lot of times you find maybe they were overcharged, and then you get into a settlement where the creditor agrees to take 50%, or maybe they agreed to withdraw their claim entirely because they've now got an adversary case against them and they just want to settle. Well, what is that exactly? Is that a discharge of income? I will tell you, for taxable entities, for a C corp or an individual, if you've taken a deduction for that you took a tax benefit for it that reduced your taxes or increased the net operating loss, then you have to include that adjustment as gross income. But for a partnership that is not subject to federal income tax, are you required to include something like that in gross income? I have gone through the Section 61 and Section 111, and I see nothing in there that requires a partnership to include basically an accrual reversal as an item of gross income. And if you think about it, so what would you do with it then? Well, there might be an argument to include as a negative expense. Certainly when it flows out to the K1, it's still going to be included as an item of ordinary income. So as it relates to the partner, you're not going to violate any Internal Revenue Code rules there. But what you are going to do is you're going to affect your state income tax. I say that if you have a margin tax, you're going to affect that. But if it's a true state net income tax, it's not going to have any effect. But some of these taxes are excise taxes, and so you want to look for ways in Section 61 to get that off of the gross income lines. Section 108, you're gonna, if you're not in bankruptcy, if you are in bankruptcy, you gotta use the bankruptcy exclusion. But if you're not in bankruptcy and you may have to recognize it as cancellation of debt, or if you have the option to reduce your tax basis in your depreciable property, that would obviously affect a state tax return. Intercompany transactions and affiliates can create all kinds of headaches. We have combined reporting rules in Texas where you have to combine a interrelated company if the ownership is common by more than 50%. But if you have a plan that terminates the equity of the subsidiary as of even as of one day before the end of the year, that can provide an argument that the entities are no longer subject to combined reporting, and that will obviously affect your state tax. We have very generous small business exclusions in Texas, and so if you could take 4 entities that are combined, split them up into 4 separate tax returns on account that they're no longer required to do combined reporting, that can significantly reduce your franchise tax, and that is very easy to do merely by choosing good language in the plan. So again, the state tax provisions is kind of a third opportunity. We've talked about you want to look at your sourcing rules, especially as it relates to sales of intangibles and how cancellation of debt is allocated. And the fourth layer, I call it kind of the Hail Mary. You want to look at U.S. constitutional challenges. If you have a really unfair apportionment result as a result of cancellation of debt and how the state allocates that, you might have a constitutional argument. A disparate impact in partnerships. What I mean by that is that a lot of these states, particularly Texas, they use federal forms to recognize revenue on the state tax return, and so what that does, or what that can do, is create a disparate impact for partnerships. Because remember, partnerships have to recognize cancellation of debt, and whether or not there's an exclusion, that determination is made at the partner level. But the same is not true for C corps or S corps, or perhaps a trust or an individual. Where Texas, we're not tax individuals, but your state might. And so if you consider that those entities are allowed to use Section 108 to exclude COD from their gross income. Well, if your state is taxing cancellation of debt merely because they're using federal forms to pick up revenue, and they're not providing some kind of a similar avenue in the case of cancellation of debt to exclude it from revenue, then you may have an argument for disparate impact. Basically, that it's a violation of equal protection, a violation of due process, to force these partnerships to pay tax on cancellation of debt merely because the federal tax law requires them to pass through the cancellation of debt income. Wilshire Courtyard, again, this is a really neat case. If you get time, you need to, and you like this kind of stuff, you need to read through it. It involved a partnership that had a lot of cancellation of debt, but they did not recognize the COD on its state tax return. The partners themselves recognized COD income, but claimed an exclusion, claimed a federal exclusion from it. The California Franchise Tax Board, they argued that the partners had a deemed distribution in excess of basis that they were subject to state income tax on, and the bankruptcy court pointed to the case of United States versus Bays that basically showed that California had adopted the taxable entity theory for partnerships, and that therefore, because partnerships themselves are considered taxable entities, at least for California state tax purposes, that the application of Section 346 of the Bankruptcy Code applied to debtor partnerships at the partnership level. And therefore, for state income tax purposes, there was no cancellation of debt that flowed out of the bankrupt partnership to the partner. And they further opine that the COD income does flow out for basis purposes, much like tax-exempt income, and so it increases the basis, which offsets any deemed distribution. So this can be very powerful for out-of-state partners or even in-state partners. But basically, think that you have this basically you have in federal tax law, the reason it passes through and requires the pass through of cancellation of debt income is because those attributes, those tax loss attributes, are at the individual level. Well, that's not always the case for these states, and so basically, when these states have decided that they are going to make these partnerships, and the same may be true for S corps, when they decide they're going to make them taxable entities, I think they are also volunteering into Section 346 as well, that income, at least discharged in a Title 11 case, will not flow out to any partner for state income tax purposes. I do want to reiterate that the Ninth Circuit did not rule on this issue. They kicked the can, but the BAT CPA did uphold the bankruptcy court on this determination. I just say that because I would not hold it up as substantial authority at this time. But nevertheless, I think the argument is very sound. If you look at the recent guidance coming out from where the states have made these partnerships taxable entities to avoid the assault cap, the $10,000 cap limitation for individuals that deduct income taxes. The IRS has come out and blessed that. It basically said, okay, if you're going to make that a taxable entity, then we're going to allow you to deduct those taxes at the taxable entity, and you're not going to have to pass them through to the individual. So really, I think this concept has a lot of meat to it. And with that, I'm sorry I didn't get a chance to go over the responsible party considerations. There's some good material there. And just realize that some of these states have draconian rules that allow even non-trust fund taxes to be non-dischargeable tax. Ken, what can you tell us about creditors? I'm sorry I went over a little bit on my time.
It's perfectly fine. I deserved it for being a couple minutes late, so it's all good. I want to thank you two for taking the heavy lift here. I got the easy section today, so I'm glad for that as well. So we want to take just a couple of minutes and talk about what's kind of the redheaded stepchild of bankruptcy matters, and that's the unfortunate unsecured creditor who finds himself on the receiving end of a bankruptcy with little or no control over anything that's going on, and not only all of the business issues that come along with that, but also the tax accounting that they now have to unwind in their books and records. There's a lot that goes into making the determination of what's going to happen on the tax return of that creditor entity. And certainly, number one on the list, and some of what everyone's been talking about, is what's the nature of that underlying transaction and what's the form of the recovery? Are we getting cash? Are we getting stock? Are we getting a bag of beans? Are we getting a future promise for something? All of this comes into play. And on top of that, you layer in now, are we a corporate entity or a partnership? Are we an individual? All of these things can have a very different result in the outcome on what it's ultimately going to look like. Of course, method of accounting comes into play, right? Particularly on accounts receivable. If we're a cash basis taxpayer, we don't really have accounts receivable. We don't really have bad debts. So that comes into play. The tax residence. Are we dealing with a foreign entity or a domestic entity? We have effectively connected income or not? Is the origin of the claim on our books? Is it capital? Is it a receivable? What does it look like? And I think Andy mentioned it, but the whole tax benefit rule. Did we get a benefit for this transaction in some prior tax year, so that now as we're getting our recovery or lack of a recovery, do we need to look to unwind that benefit that was received in a prior year, or in some cases, the revenue that was recognized in a prior year? And I kind of look at the creditor pain index as we as practitioners are listening to our clients who are on the receiving end and how much attention they're actually willing to pay to it, and engage us in trying to understand the tax nuances of what's got to go on in their books and records. And a bunch of stuff here that kind of comes to mind. Are we a critical vendor? Are we actually going to be able to get paid on some of our pre-petition obligations, which would be a wonderful thing? Do we have preference exposure? Are we going to make noise? Do we have preference exposure? Maybe we just want to kind of be quiet and live to fight another day. Are we a related party? What's the size of the impact to us and the revenue that we're getting from that debtor? Is it meaningful to us? At the end of the day, in an 11 plan, there may be a recovery to be had that can be determined how we're going to deal with it now based on whether or not our debtor is a corporation and whether we're a similar type entity. For instance, if we're getting partnership interests in return for our claim, if it's simply a profits interest, there may not be anything to do right now because it's a future promise. Nothing has occurred. There is no clear-cut tax rules on that as of yet. If we're getting a recovery based on the services, well, those services probably were not recognized because we're likely a cash basis taxpayer, that's now ordinary income to us. So again, you've really got to look at the nature of the claims and the underlying issues that come along with it to be able to determine how you're going to deal with it on your tax return as a creditor. In the case of a corporate debtor, here, if we're getting stock, we may have a shorter long-term gain. If we're getting a interest on our claim, that's going to be income regardless. So, same rules. You've got to pay attention to what's going on here. At the end of the day, the big question is always the bad debt. When can we recognize it? Can we recognize it? Inevitably your client is upset as it is, and they are just looking to kind of write it off and move on with life. Well, 166, as we all kind of have run into over the years, kind of slams the brakes on some of that discussion. If you've got a non-corporate debtor, and where it's most relevant or evident is when the shareholder has loaned money into the company. Well, these individual non-corporate debtors are not in the business of loaning money. That being the case, any deduction that's available to them is simply going to be a short-term capital loss, which whether or not they have other capital transactions, they may be able to just write off $3,000 a year for forever and it not be terribly worth a whole lot of money to them. On the other side of the equation, though, if we are in a position where we may be able to claim a worthless deduction in its entirety, that deduction, of course, is limited to the adjusted basis of the item, and the timing needs to be tied back to an identifiable event. It can't just be the fact that the debtor filed for bankruptcy. That in and of itself is not an identifiable event. It's certainly an indication that it may be worthless, but by itself, it's not that magical identifiable event that the IRS wants. So in that context, if the debtor has filed for a Chapter 7, you're probably winning the day in that it is a worthless item. If, on the other hand, we have a Chapter 7 asset case, a Chapter 11, a Chapter 13, where there may be some recovery, albeit even dinky, it's only partially worthless, and you're not going to be able to get that deduction right out of the gate. 166 does allow for a partially worthless bad debt, but there's similar handcuffs. It can't just be the fact that it's an asset 7 case and we think we're going to get 10 cents on the dollar, or an 11 where we think we're going to get some measure of recovery. We need to be able to substantiate that amount and quantify it in order to claim the deduction. And that is what the IRS is going to be looking for if they ever come knocking to question your bad debt deduction. So a bit of a minefield to have to cross over. Creditors definitely get the short end of the stick in a lot of this, and they certainly are going to be coming to you looking for some guidance on what advantage they may be able to take to kind of move on with their life and to offset things. aside from the fact that they may be looking for some guidance when they find out that there's a claim, particularly if there's a landlord involved, brings up a whole new set of issues that are way beyond this conversation that you may need to address with your clients. With that, we're just about at time, and kind of open this up for any questions that may be out there, and see what we can do.
Okay, first question. Please look into your crystal ball. Are we expecting the Biden presidency to make any changes to what we've talked about today?
I don't know about anything today. The only thing that I know that is currently been banging around is as it deals with subchapter 5, the debt limit of $7.5 million is scheduled to sunset in March, back down to 2.7. And there has been some conversation about that either being retained or increased. That's about all I have as far as what I'm aware of what may be banging around Congress.
Okay, great. Second question, and Andy, this is good for you. What is non-recourse debt, and how does it work?
Well, that's a difficult question. I mean, really, recourse versus non-recourse debt, and trying to define that is a long topic. But generally, recourse debts are going to be debts that you're personally that you're going to be expected to repay outside of the entity. So a partnership, and it only comes up in a partnership. Well, it comes up a lot in a partnership context, but the partners themselves will have to be responsible for paying it back. Whereas a non-recourse note, you can generally just walk away from the property. You walk away from the partnership, and the partner will not be expected to repay if it relates to a real estate, maybe a mortgage. You'll be able to basically walk away from the real estate and not have to pay when they sell it and are not able to satisfy the debt obligation with the sales proceeds. So recourse, obviously, if you sell the property and if the foreclosure sale sells it and it doesn't satisfy the note, then you have to fork over money, on top of losing the property. That's kind of in its simplest term.
Okay, very good. All right, well, I hope that everyone will join us on Friday, December 4th for subchapter 5. Well, Ken will be back with us with a bankruptcy lawyer, Michael Markham, and also watch the replay on YouTube of our November 4th presentation. Ken and Andy and I plan to work together on further presentations. We would love any questions, comments, or suggestions you might have. But otherwise, Andy, Ken, any last words before we sign off?
On state local
enjoy
matters,
your Thanksgiving.
Yeah. Enjoy your holidays. But on state and local matters, boy, you're really gonna have your work cut out for you as it relates to some of these issues. But treat it with respect. Spend the time on it, and you will find those opportunities. And if you don't, and you get a bad result, they're liable to come hire, or at least have somebody like me take a second look at it. And if my result is much better than yours, then chances are you may be out the door. So
yeah,
very
good. All right, well, thanks again, guys. You've taught me a lot and continue to teach me. I really appreciate it. Have a fantastic day.
Thanks for having us, Al.
Well.
Bye.